Hello, everyone. Welcome back to another edition of the Week in Charts. Charlie Bilello here, and I'm here to bring you the most important charts and themes that I'm seeing today in markets and investing. Exciting week. We got a lot to talk about, so definitely stick around to the end. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment. I read all the comments, try to respond to as many as possible. So definitely subscribe to the channel for more content just like it. And if you're watching this and you're looking for a second look on your portfolio, if you want to know if your money could be working harder for you, we do all of that and more at Creative Planning. So reach out today, creativeplanning.com/Charlie. Fill out this form, schedule a call or a meeting with an advisor. You're going to get a free wealth path analysis from us. And in that, we're going to look at your portfolio. We're going to look in terms of your retirement or financial independence review and make sure you're on the right track. We're going to give you proactive tax strategies, and we're going to do an insurance and estate planning review, making sure everything is in order there. So reach out today, creativeplanning.com/Charlie for your free wealth path analysis. At Creative Planning, we have over $300 billion in assets under management and advisement. We're in all 50 states, so we likely have a location right near you, and we're here to help. So reach out today, creativeplanning.com/Charlie. So what are we going to be discussing today? The number one has to be the cooling labor market. A number of statistics I'm going to show you pointing to a continuation of that trend and perhaps maybe even an acceleration depending how you're looking at it. Number two, longest inversion in history is over. So we've been talking about that inverted yield curve for over 2 years. And one part of that curve now is in positive territory. Again, we'll discuss what that has meant historically for the economy. Number three, be careful what you wish for. And this is an important concept that a lot of people seem to be begging for a 50 basis point rate cut in September in a few weeks. And I'm going to make the case that you don't want to see that based on market history. Number four, a September swoon or something more. That's the question people are asking. We had a little bit of difficult week here in the financial markets. We tend to see weakness in September. I'll walk you through that data. Is it something more, or is it just a little bit of a pullback here? Number five, dollar store downturn. Dollar Tree reported earnings. A number of these discount retailers having a very tough time. Walk you through the data that's suggesting that this is one of the worst pullbacks that we've ever seen for Dollar Tree and other discount retailers. Number six, wages outpacing inflation. This is the positive. We always end with something positive. This is good news, and we got good news in terms of the increase in hourly earnings in the employment report. So one thing to point to this week in terms of positive, it would be that number. Okay, let's start out with the cooling labor market. Many signs pointing to this. We got first that ADP report. It's showing private sector payrolls came in at 99,000. So 99,000 private sector payrolls were added, well below estimates of 140,000. The prior month was revised down as well. This was the lowest reading we've seen since January 2021. So it's been quite a while where we've seen above average private sector payrolls being added to the economy. And now we're down lowest level since January 2021. And we got this number out of Challenger here. They talk about job cuts. They look at hiring plans of different employers. And what they're showing here is the number of job cuts has spiked in August. And what's unusual about that spike was, with the exception of 2020, we haven't seen a spike this high in the month of August since 2009. So big spike. There's over 75,000 job cuts in August. Is this a one-off, or is this pointing to something more? We'll have to see the next few months if this continues. But the other kind of alarming data point would be that the hiring plans from employers is really pulling back here. So this is a crazy stat that you got to look at. U.S. employers have announced 79,000 hiring plans so far this year, which was down 41% year over year. So this point in August last year, we're looking at 135,000 and change, and now we're looking at 79,000. Big drop over the past year. And this is the crazy stat that I was really surprised at. The year-to-date total in terms of hiring plan announcements is the lowest on record. They have this data going back to 2005. It was even lower than 2008 when we were already in a recession where we saw a little bit over 80,000. So this is an indication not just that employers are increasing the layoffs if we look at that, but also pulling back in terms of new hiring, and really the job opening data would support this thesis. If we saw, looking at the JOLTS data here, big drop in the latest reading, now down to 7.67 million. That's still, if we go back before, pre 2020, that was still pretty high, but we're now coming way down from the peak here of 12 million. So this is the fewest job openings in the US since January 2021. And a lot of people say this is kind of, this data isn't really accurate. Perhaps the number is even lower. Regardless, the trend is coming down and we're getting closer to parity with the number of unemployed people in the US. So we had this huge spread. We had the tightest labor market in history over here. We had over 12 million job openings, way more than the number of unemployed, which is, I think, as low as around 6 million. So huge spreads, over 6 million spread. And now we're about 500,000 in terms of 500,000 more job openings than unemployed persons. And I would suspect this is going to cross over at some point in the next few months. And if we look at the payroll data we got in the non-farm payroll report, it was definitely overall, I would say, a weak report. The unemployment rate did tick down a little bit to 4.2%. That was expected, but still remains well above where it was last year at the cycle low at 3.4%. And I'll come back to this table here that I showed last month. Whenever we've seen a 0.9% rise off of a cycle low, the economy often has already been in a recession, or in 2020 was just about to start entering a recession. So the question is, again, is this time different? Or are we going to see a recession? Are we going to see this weakness in the labor market continue? In terms of the actual number that came in, I don't never put much emphasis on this because there's always huge revisions after the fact. And we got revisions again this month in terms of looking at July and June. They actually revised July down 25,000 and June down 61,000. But the number for August, 142,000 jobs were added. It's what they said that was below the estimate, 160,000 jobs. So overall, you can see the trend, less jobs being added. This was still the 44th consecutive month of payroll growth in the US. You can see here that tends to be where it kind of peaks out for whatever reason. We did have this outlier here where we had 113 consecutive months. We had the longest expansion in history following the global financial crisis and the Great Recession. But other than that, this is kind of where that payroll streak has ended in the past. And where are the jobs being added? This has been the top jobs have really come from healthcare, leisure and hospitality, and government, and they're among the top again. Notable weakness here in manufacturing, down 24,000 for the month of August, and that really confirms, I would say, the weakness we've been seeing in the ISM manufacturing PMI. We got another weak reading in the latest report, 47, below 50. Anything below 50 is contracting. And we're almost in uncharted territory in terms of this number being below 50 for 21 out of the last 22 months. So very rare to see manufacturing stay down below 50 for this long in contraction. In fact, this data goes back to the 1940s. We've only seen this happen one other time, and that was the period from 1989 to 1991, where it was also below 50 for 21 out of 22 months. And we also had, of course, a recession there in 1990, 1991. So another data point perhaps suggesting we're entering or getting closer to a recession would be if you're looking at manufacturing. If we're looking at jobs growth slowing, this is the number I prefer versus the looking at how many jobs were added for a particular month, because it really shows you the trend in terms of that jobs growth. And you can see here the trend is decelerating. So we've increased the number of jobs in the US by 1.5% over the last year, but that's the slowest growth rate we've seen in a number of years. So historical average is around 2%. We're now running below that. So that really tightest labor market in history that we had just a few years ago. Now we're definitely starting to enter a much looser period for the labor market. The one bright side, I would say, in terms of looking at the labor market has been the move lower in jobless claims. So the number of people who are filing for unemployment claims, we were getting worried a month ago in August, talking about that rise trending higher. We also got that bad employment report a month ago. We got another one this month, but the difference here is this is now trending down. Last 4 weeks moving lower. So perhaps this tends to be a leading indicator. We'll have to see where it shakes out in the next few weeks. You definitely don't want to see this start to trend higher, because well before we'll see it in the payroll report in terms of job losses, you're going to see this start to really trend higher if we're entering a recession and we're entering a period of job losses. So watch this number closely. Initial jobless claims week to week, and what you want to see, of course, is it move back down again like it did last year. So we had a spike higher last year, but it went down. The difference being this year we're seeing all these other signs in terms of lower number of job openings. The quits rate is down. We're seeing the number of layoffs going up, hiring plans coming down. So a lot of confirming data suggesting cooling. But this would be, I guess, the leading indicator that you want to look to, because, again, it tends to spike. It tends to trend higher before the lagging data that we see in the payroll report in terms of number of jobs that are being created, because that's often revised after the fact lower. So when you have a recession, you're going to see those numbers after the fact saying, well, they weren't actually this high. They were actually much lower, or maybe even negative. So I want to talk about the yield curve, because the longest inversion in history is finally over here. Not totally over if we look at the whole yield curve, but the one that a lot of people look at is the spread between the 10-year and the 2-year Treasury yield. And normal yield curve is that the 10-year is going to have a higher yield. You're locking your money up for a longer period of time. It should give you a premium. It should give you a higher yield, but that's not what we've been seeing for the last 783 days. Over 2 years, we've been seeing this weird inverted yield curve where the 2-year Treasury yield has been higher than the 10-year, but that has flipped back to a positive spread here between the two. With it's only 1 basis point, but it's still positive nonetheless. So it ends this record streak. And you can see here, I just took a snapshot of yields before I jumped on this video. 2-year Treasury yield right now 366, 10-year 367. And so what we're seeing is a normalization, but not the entire curve. You see here, the shorter end of the curve is still well above the 10-year. And why is that? It's because the Federal Reserve controls this area of the curve, and they haven't yet cut interest rates, although this has been moving down in anticipation of that cut. By the time they cut rates in 2 weeks, this is already going to have priced it in more than 100%, I would say. Okay, so what has happened historically when you flip back to positive territory? So a lot of people focus on that inversion because it's a leading indicator of a recession. But what people forget is there's often a long lag between that first time the yield curve inverts and when the recession begins. It can be, I think on average, it's around 2 years. So we're about 2 years into it now, but it can vary. It could be 12 months, it could be 3 years, it could be longer. The real better signal seems to be after that period of inversion, that long period that went back in history and looked at some of the longest periods here. After it turns positive again, after these big streaks, well, then you're actually much closer to a recession. So let's go back in time, look at some of these data points. March 2007 flips back to being positive. A recession begins 10 months later in January 2008. December 2000 flips back to positive. You have a recession 4 months later, April 2001. June 1989 flips back. Recession starts in August 1990, 13 months later. And then you have the early 1980s, October 1981 and May 1980, where actually the recession had already begun before this flip back into positive territory 2 months or 3 months earlier. So does that mean a recession has already started? It doesn't obviously mean that it could, if we're looking at historical data, could be 10 months from now, could be 13 months from now. But historically, if we're looking at the last 40 years at least, after a long period inversion, we've seen a recession either a few months before or up to 13 months after. So, of course, we won't know, let's say, for another year. Maybe we'll know earlier if we get confirming economic data. But pretty good historical precedent for this kind of signaling. Well, now you're entering that recessionary period or close to entering it. So, what is kind of the pushback if you're looking at the yield curve? Well, people would say, well, it's not fully uninverted yet. If we still look at the relationship between the 10-year and 3-month, we're still 681 days and counting here. That first inverted in October 2022 and still very much inverted, highly inverted, 1.4% spread between that 3-month being above the 10-year. So again, this is not going to uninvert until the Fed starts cutting interest rates. And if they do 25 basis points, as I'll talk about in a little bit, it's still not going to uninvert with that 25 basis point cut. Even a 50 basis point cut isn't going to do it. You're going to need to see multiple cuts likely to uninvert this yield curve. So we're still going to have an inverted yield curve until the Fed does a few more cuts. And what I would say is, if you want to see this back in positive territory, if you want this to uninvert, well, and you want it to happen quickly, well, be careful what you wish for, because that would mean the economy is in a bad place and the Fed has to cut rates more aggressively. So let's talk about that in terms of what is the Fed funds rate today? What is the rate of inflation? Why are people saying that the Fed needs to cut 50 basis points? And why perhaps do you not want to see the Fed do that in 2 weeks at the FOMC meeting? So here's the data. Fed funds rate, looking at the lower bound, 525. Got core inflation, core PCE, which is what the Fed looks at, 2.6%. So what people are saying was, can't the Fed see that we're well above the rate of inflation and this number is expected to come down over the next year? Why are they waiting here? They should be aggressive in cutting and closing this gap. The Fed is always behind the curve. So if you look at here, we were saying for months, inflation's going up, the Fed's still at zero. Inflation's hitting its highest level since the early 1980s. The Fed is still at 0%. So the Fed is always behind the curve because they're looking at lagging data. The better question is, well, where should that Fed funds rate actually be? And if you think it should still be at this level because inflation is still the greater risk, well, then you should keep it there, regardless of where inflation is right now in terms of the reported data. So this notion that the Fed should be immediately responding to the inflation statistics, well, yes, in an ideal world, but they clearly don't do it in terms of the other way around when inflation's been rising. And they certainly didn't do it for 7 years when they held interest rates at zero and we had positive inflation. And so the notion that they're going to formulaically follow the rate of inflation, I think you could throw that out. I think that would be preferable if they had some formula saying, okay, we're going to keep the Fed funds rate 1% above the inflation rate. That would be better than the way they do it. But that's not likely going to happen. These are human beings. They're going to get it wrong. I don't know where the Fed funds rate should be. Where would it be if the Fed isn't manipulating this part of the curve? It was just based on supply and demand for Treasury bills. Where would that 3-month Treasury bill be? We don't know. Perhaps it would be lower. Maybe it would be the same. Maybe it would be higher. That's the point here. The Fed shouldn't be determining this rate because they're always going to get it wrong, because no one knows where that rate should be except for the market. So if we're looking at, I would say, the case to be made to go slow here and not jump and do 50 basis points, it would still be the fact that inflation is well above trend. So yes, we're moving down to 2% in terms of the year over year rate of change, but that doesn't erase all of this inflation that we've had above that 2% trend over the past few years. So we're still 11% above that trend, and we're still going to get a CPI reading that's above 2% next month, even though I expect it to come down to around 2.6%. That's still above 2%. So uh, the argument to do 50 basis points in my mind is saying just forget about this inflation target, forget about it. Just look at the economic data, look at the employment data. It's weakening, so the Fed should start cutting interest rates. And to me, that's a kind of ridiculous notion because the idea that the Fed can prevent labor market weakness or prevent a recession by cutting interest rates, clearly not backed up by history. They cut interest rates to zero in 2008, didn't prevent that recession. They cut interest rates down to 1% in 2002, 2003 period. That did not prevent a recession in 2001. So this idea that aggressive cutting of interest rates is going to prevent what might be an inevitable recession, I think is not backed up by history. But what are the markets saying? This is what the Fed, I think, is going to do heading into that meeting on September 18th. They're going to do whatever the market's expecting it to do. And right now, the market's still saying 25 basis points, not 50 basis points. This is going to jump around based on the data that we get over the next few weeks. And if the Fed wants to telegraph 50 basis points, I think they'll do it before that meeting. I think there'll be some speech or some announcement that they're going to do 50. This is what the market's saying: 25 in September, jumping to 50 in November. December, you get 25, and January of next year is 50. So going back and forth between 25 and 50 over the next few months. Who really knows? When we get that September FOMC meeting, I think they'll make it clear more what their intentions are in terms of, do they want to continue to do 25 basis points, or are they going to potentially ramp it up based on the weak employment data that we're seeing? I think they'll likely give a strong signal at that meeting. They're going to update their financial projections, their dot plots. So we're getting close to the end of the year. They're going to want to match up with those dot plots. So if they say we're going to cut 100 basis points between now and the end of December, I think unless something changes, you're going to probably get that. So maybe you do get a 50 basis point cut at some point. So this is what I'm saying in terms of be careful what you wish for. When we've had periods where the Fed thought it was necessary to start a rate cutting cycle with a 50 basis point cut, that has not been good for the stock market. That has not been good for the economy, because it has meant that the economy is already showing significant economic weakness. There's really nothing the Fed can do about that. So the Fed started cutting rates in September 2007. That was before the recession began. They did it with a 50 basis point cut. And just like today, people were imploring them, cut 50 basis points. Don't do a small interest rate cut. Don't you see that there's going to be an economic downturn? You got to get ahead of it. You got to cut aggressively. They ended up listening to that and cutting all the way down to zero. Again, that did not prevent the recession. In 2001, they start cutting interest rates from 6%, bring them all the way down to 1%. Did not prevent the 2001 recession. Then we look at this other periods in 1995, 1998, 2019. We had 25 basis point cuts, and that was a period looking forward that was actually good for financial markets. So what I would say, this is not a big sample size, so you don't want to draw too many conclusions from this. But what I would say is, if you're a stock market bull and you want the stock market to be higher a year from now, you should be careful what you wish for in terms of begging for a 50 basis point cut or begging for substantially lower interest rates over the next year, because that would mean we're likely to see an economic downturn, and then we're likely to see earnings go way down. That has typically happened during recessions, and then you're going to see a revaluation in the equity markets. So what has been the reaction to stocks to that employment data, to that weakness in the labor market? Well, similar to what we saw in early August, we're seeing a decline, which is interesting because we obviously recovered those losses from August. We talked about the move from panic to euphoria, and entering September, this is one of the best starts that we've seen for a year in history, up 18% for the S&P 500. It was the single best start through 8 months to an election year ever. Just incredible, up 18%. You add a little bit more for dividends, you're over 19%. You're approaching 20% essentially through 8 months. One of the best starts we've seen in history. But as we talked about on the last episode, stocks really priced for perfection, because that run up this year, the run up last year, we had a huge return in the S&P 500. It's really outpaced the increase in earnings. And so we're looking at the highest valuations that we've seen since 2000 in the equity market. And so we start out September, seems very promising. Everyone's bullish again. And then all of a sudden, you get this VIX spike once again, spikes 38% on September 3rd. S&P's down over 2%. So it goes from 15 to over 20. Not a huge, not like what we saw on August 5th, but a significant spike, top 25 historically going back to 1990. And then we get this, we remember that it's September. And what happens in September historically, it's been the worst month. So S&P 500 average decline in September 1.2%. Only one other month, that's February, going back to 1928, has a negative average return. And September by far the worst. And September is the only month actually that is below 50% in terms of the percentage of positive months. So every other month, we've seen a more positive months, monthly returns than negative. Not true for September. And then we look at the last 4 Septembers here, all negative. So we had a 5% decline last year, September 2022. That was right near the low of the bear market, down 9%. September 2021 was a great year for stocks, but was down almost 5%. And 2020, another strong year for the equity markets, was down 4%. So just this weird situation, and you could say it's randomness, it's noise, probably is, but this weird situation that where investors seem to be inclined to sell stocks in September. And so what we're seeing here, just a little bit of a pullback. We had this enormous rally, almost got back to all-time highs for the S&P 500. And this week we're down about 4%, which feels like a lot because we had just a really rip-roaring advance. Again, almost hitting all-time highs again. We look within the S&P 500, I'd say this is the more concerning data in terms of what's going on, what's been the action, price action over the past few months in terms of sectors, in terms of stocks. Number one, we got to talk about NVIDIA. Covered it a lot last week, but the downward move has continued after reporting earnings. Down, as I'm talking here on Friday, currently down about 14% on the week. And you can see it hasn't touched that 200-day moving average in quite a while. And as you get closer, it tends to be a magnet in terms of getting there. I would not be surprised if we got there at some point in the next month. S&P 500, you can see it's been a very long trend. You have to go back a while before it's tested its 200-day moving average. And so both of these things potentially could happen here in the next few months. And what we're looking at here, this is just stunning. The volatility in terms of NVIDIA's market cap is something we haven't seen before in history. Of course, it's one of the biggest companies now in terms of market cap, but these swings going back and forth in terms of adding market cap and losing, it's just incredible. It's adding more than almost every company in the S&P 500 has a market cap below 300 billion, and except for the top 20 names or so. And NVIDIA is doing that on a daily basis, it seems like, in terms of, it was up in July 31st, it was up 323 billion on a single day. That was the largest change in market cap, largest increase in market cap for any stock in history. And then on the downside, September 3rd, this week, we saw a $279 billion decline. That was also the biggest decline for any company in history. And here's the data. In terms of that, you can see NVIDIA, largest market cap declines. NVIDIA, if we look at the top, is all over here. You have also Meta and Amazon, and most of this has happened this year. And in terms of the upside, NVIDIA has the top 3 market cap gains as well. So just stunning volatility. And historically, there's kind of a saying within market participants, and traders often look at that, where you tend to see a spike in volatility near like tops for stocks that have done very well or sectors. You tend to see just more gyrations back and forth. And the reason for that is that uncertainty is really building when you have valuations as high as something like Nvidia is trading at. And so any data point that's bad just triggers an emotional response to sell. I have this enormous gain, let me get out. And then when there's good news, you see this lift as well, because the swings in terms of Nvidia, in terms of profits, in terms of revenues, have been enormous as well. So you have both sides, big up days, big down days, and you tend to see that around tops. We'll look back in hindsight and say whether that was the case once again. But it's not just Nvidia that's having weakness in terms of its stock. We're looking at the semiconductor index here. The SOX, it had its biggest one-day decline this week since March 2020. So on September 3rd, down almost 8%. And that's a big move. And if we look at semiconductors versus the S&P 500, this has been one of my charts to watch for the back half of this year. We had hit its highest level since 2000 in terms of this relationship, and now it's trending lower. You can see this is the SOX ETF versus the S&P 500. It's actually below where it was when it started the year. So ex Nvidia, if you look at the semiconductor stocks as a whole, really starting to pull back relative to the market. And this is important because semiconductors are a leading indicator for tech, and tech has been the leading sector, of course, in the market. And speaking of that, look at this relationship between technology stocks in the S&P 500 and the overall S&P 500. We noted back in July, I think it hit a record high, surpassed the high from March 2000. And now you're seeing just this sharp reversal in terms of technology stocks underperforming the S&P 500. I think this is easier to see it here. Looking at the sector ETF performance, you'd actually now have the tech sector, the XLK ETF, up 9%, the consumer discretionary ETF up 5%, and boring safety trades like utilities up 23%, staples up 17%. So really reversal of leadership. Of course, this has people worried as well, because you tend to see that at the start of bear markets and recessions as well. You tend to see a rotation from more cyclical sectors like tech, like discretionary, and into more sensitive and certainly utilities and consumer staples, less sensitive to the economy, and definitely utility story has been helped by declining interest rates, as I'll talk about in a little bit. So watch this sector action closely here to see if this continues. Obviously, was a secular sea change for technology after March 2000. Did we hit some kind of secular peak? That is the question for investors. And similarly, looking at value and growth here, talked about growth stocks outperforming value stocks, highest relationship also since 2000, back in July. And now we've seen just a pretty sharp reversal. They're almost at parity now for the year, and growth stocks had been outperforming value stocks by just an enormous amount only a few months ago. So watch that relationship as well. And then talking about bond yields here, this is concerning if you're worried about the economy. You don't want to see bond yields, and particularly on the long end, screaming lower at a very fast pace. That's what we're seeing here over the past week. We got the 10-year down to 3.68, 3.68%, lowest since June 2023. You can see here it peaked at almost 5% last year, so down considerably from there. And bonds have really benefited, of course, from this move lower in interest rates. So just like they were hurt by this move higher, they've been helped by this move lower, about 1.4% off the peak there. That's helped the aggregate bond ETF. It's up almost 10% in the last year, outpacing cash or treasury bills by a wide amount. So as I talked about in a previous episode, the bond market's front running the Fed's move. So they know the Fed has telegraphed they're going to start cutting interest rates, and bond investors are not waiting around. They've been locking in, as soon as it became clear the Fed's going to cut rates in September, they've been locking in these higher interest rates because that short-term yield on treasury bills is going to come down. It's going to come down fast. So interesting to see the bonds outperforming cash, because a year ago people were saying, well, why should I take any risk in bonds? I could just make 5% on my money. And what we were talking about a year ago is you're going to want that bond exposure in your portfolio if we start to see economic weakness, if the Fed starts cutting interest rates, because all of a sudden you're going to get that more normal relationship where bonds actually do well when you get bad economic news, and bonds actually do well when interest rates are on the decline. So in terms of the bond market, still in a drawdown. This is the longest drawdown in history, but we're getting closer. We're now down only 6% off of that peak in 2020. It's over 4 years now we've been in a bond bear market. Haven't hit new highs here, still down 6%, but we were down as much as 18% in 2022. So bond market moving more normal. That 60-40 portfolio that said everyone was saying was dead over here in 2022 because stocks and bonds were both down together. Well, since that point in time, bonds now starting to get back to a more normal rate of return. And long term, what does the bond market do? As we said, it does what that beginning yield is. So if we're looking at 3.7% around for the 10-year, that should be kind of your expectation for bonds over the next 7 years. In between now and then, it's going to be dictated by the movement of interest rates. So number 5 here, dollar store downturn. Dollar Tree plunged 22% after it cut its full year forecast. And they cited increasing pressures from middle income and higher income consumers. Interesting data point there. We've been talking about retail sales weakness, but really pronounced, it seems like, in these discount stores. And customers, they're saying, are making trade-offs after a prolonged period of pricier food and everyday costs. And these dollar stores, they used to sell, a number of them used to sell items only at $1 at 99 cents. And then they had to change that with the inflationary picture. They couldn't do that anymore. So they had to raise prices above those levels because you just had enormous amount of inflation. They were starting to really eat into profits there. And what they're saying here in terms of this decline in their forecast really hit the stock, because I suppose people were not expecting it. So you don't tend to see this type of company move this volatile 22% in a single trading day. We haven't seen that big of a decline since March 2001, and third biggest in history, 24.8% back in March 2001, and in December 2000, 43.8%. So looking here at the fundamentals, you're looking at negative net income for Dollar Tree over the past year, and you have revenue growth here decelerating very rapidly, just barely above even, so up 0.7% over the last year. Here's the data points looking at all of these discount stores, year-to-date performance. It's not just Dollar Tree. Dollar Tree's down 55% year-to-date. Dollar General, 40%. Five Below, 65%. And Big Lots just getting crushed, down 93%. So all of these stores having trouble, all citing similar concerns. Inflation being the big issue, and the consumer just trying to find value elsewhere. Where are they finding that value? Well, Walmart, bigger player, obviously, has talked about a lot about cutting prices on food, groceries over the past few months. Did it on thousands of items as well, and people have been shifting, and you can see it in the stock price here, more towards Walmart, which is up 48% year to date at an all-time high. So what a difference here in terms of these two. Walmart having a very strong year, and these other retailers absolutely getting crushed year to date. And this is an interesting thing kind of that jumped out at me here, looking at Dollar Tree's drawdowns historically. We're down a little over 60% off of the peak. And just looking back here, the shaded areas are recessions. You could see the last two kind of big drawdowns coming off of an all-time high is the 2001 recession and 2008 recession. You could see big moves lower as well. So is this yet another data point suggesting we're about to enter a recession? We'll take a look back in a few months and see. But interesting that the consumer here is really just shifting away very rapidly, trying to find value wherever they can, still obviously finding it at places like Walmart. But you would think these kind of discount retailers would be benefiting from a weaker economy. People would be looking to go there, but I guess they just simply don't have the pricing power. They don't have the same economies of scale that a company like Walmart has had over the years and continues to have. And that's really hurting these companies. So, again, we'll come back to this, but just another data point perhaps suggesting economic weakness to come. I want to end, as we always do, with something positive, and that would be wages outpacing inflation. Of course, this is a huge theme over the past year. I've been touching on it whenever I can because it's good news. You want to see people's wages go up more than prices. If we look at real-time prices here, Trueflation puts out this index of real-time price inflation in the US, and they're now saying that the actual inflation rate over the last year is actually 1.2%, which would be the lowest since August 2020. And if we look at average hourly earnings, we got in that payroll report up 3.8% over the last year. So huge spread, obviously, between this number and the Trueflation number. If we look at CPI, it's expected to drop down to 2.6% when we get the reading next week. And that would be the lowest in some time. And that would be a 1.2% spread between wages and inflation, the best we've seen this year. So obviously, just 1 month, but we've seen this now every single month for the past year where that wage growth is above the price growth, and that's absolutely what you want to see long term. What's driving a big part of this decline for CPI here? It's going to be this move lower in energy cost, gasoline, crude oil, heating oil, all the stuff moving lower. And what we're seeing here is the price of crude oil below $70 a barrel. First time this year. It's actually now down on the year. And of course, that's translating into lower prices at the pump with a lag, but we're already seeing it $3.30 per gallon average price of gasoline in the US. That's the lowest since February. And it's actually 13% lower than a year ago. So a year ago, we're looking at $3.80. Now we're at $3.30. So good news there that wages are still going up much better, much higher wage growth that we've seen historically, and inflation is coming down and coming down fast. So let's end it right there. Thank you, everyone, for joining me on the Week in Charts. If you're watching this on YouTube, hit that subscribe button for more content just like it. Have an awesome weekend, and I'll see you next time on the Week in Charts.